When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Hogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Hogan. And now here's Jeff Hogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Hogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events. We'll also talk about some answers to some key issues around IRAs, 401ks, and annuities. We'll answer your listener questions. Finally, how to know if you're prepared for retirement. My name's Jeff Shea, and as always, I'm just here to ask the questions. But of course, the words of wisdom and solid advice, you know where they come from. The other Jeff, it's Jeff Hogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how you doing today?
I'm doing awesome. How are you doing?
I'm doing great, thank you. Glad to be with you. Glad to be with all the fine people here of the greater Tucson area. We've got a lot to talk about on today's show. I want to open up by talking about some current events here. This is an unbelievable story, Jeff, that I read. Boy, talk about Doge. And I mean, looking at the way that we're wasting money in this country, believe it or not, Elon Musk posted a chart on X showing that there are more than 20 million Americans listed over the age of 100. Okay, that's fine. I've got an aunt who's 107, and, you know, they're not a lot of people, but there are many people who are over the age of 100. But out of these 20 million people, it included 3.9 million people, Jeff, in the 100 to 139 age range. I don't know anybody who's 130 years old. More than 3.5 aged 140 to 149, and 1.3 million in the range of 150 to 159. There's even an alive citizen over the age of 360, according to these records. How could something like this happen, Jeff? I mean, I think Doge is something that we needed in the past, and boy, I think we're really going to find a lot of wasteful spending. What do you think?
Well, you know, they've talked about it a lot of the year. I saw some quotes on, back in the Al Gore, Bill Clinton days, and other presidents. It doesn't have to be just the current party that's trying to be fiscally responsible. They've all talked a good game, but nobody's done it. But, the thing that I understand and that I've heard is that not only do these checks get written to these millions and millions of people that are over 100 and obviously dead or, should be in the Guinness Book of World Records, as Elon Musk pointed out, for being 130 years old or even older. The checks are getting cashed. And so that's obviously fraud. And, I understand if somebody dies and they don't, just turn in a death certificate because they don't have survivors or anybody to report that. And then pretty soon the checks go uncashed, or they go into a bank account that ends up not being closed, but eventually gets closed. And then the checks bounce back and they realize by default, oh, this person must have died a few months ago. Whoops, we better stop that. And let's get the money back from the bank if it deposited in that account or whatever. But I don't think anybody's really manning the ship there, and doing the accounting. They're to write checks. And, I don't know how many people are insiders, meaning the people in the industry or in the business, in the Social Security Department. There's so many ways it seems that government officials are using it for their own benefit. And I appreciate the opportunity that many people have to get into a public service type role, have a good salary, have a good retirement, and serve the public and keep the community safe and keep the communities with the infrastructure builds and the, management of the towns and the growth and all the different things that have to go into it do require a certain amount of skill sets. But, when you've got your fingers and so much access to the purse, basically, how tempting is it to just, find ways to grab your share and know that there's no real oversight because you are the oversight or you are the one just, pushing the buttons to pay checks. I mean, where are they going? Are they being redirected to a bank account in that person's name that really is getting deposited into, Aunt Betty or Sister Jane or Brother Joe? I don't know how much of this is insider, and I hate to be so skeptical and such a conspiracy theorist, but it used to be that, conspiracy theories were just these outrageous ideas that never came to fruition. But now, conspiracy theory becomes truth 6 weeks later on a regular basis. So, I don't think it's a conspiracy that, this is being done on a certain amount of negligence. I think there's a lot of negligence. I don't think government workers, unfortunately, and I know that those listening might be offended, but not all government workers are there because of necessarily they're the most competent and perfect person for that job. Many of them are, but I think some of them know that, because it's a government job and they're pretty solid, that I don't think they have to, work extra hard. And by the way, I have a lot of clients that are ex-government employees. I think a lot of them, and this certainly is not a broad brush stroke, but the bottom line is it's an atmosphere where I think fudging and maybe getting your hands a little bit dirty is easier to do than, say, in a public company where you're being audited, where you have people looking over your shoulder and you have to watch the bottom line to such a degree because stockholders, SEC, regulators, banks, everybody else is looking at you. But in the government, I think there's less people looking at you because they just assume, they're either self-regulated or somebody's regulating them. Well, when you're self-regulating, I'll tell you what, self-regulating, I wish I could be a self-regulator when it came to driving. If I could self-regulate and just say, well, don't worry, officer, you don't have to stop me. I'll just, I'll let you know when I drive too fast and I'll write my own ticket. Baloney, who's going to do that, right?
Mm-hmm.
I'm not going to, it's hard to self-regulate. I'm not going to self-regulate or like, man, I drive too fast. I can't write myself tickets every day. Geez, I'll just fudge a little bit here. I'll just write one every once in a while. Maybe that's the way a lot of these government entities are, because it seems like the private sector, private businesses, even public businesses, even the corporations, the regular Main Street Joe and John Dane, Joe Blow and Jane Doe, whatever, are being scrutinized and watched over because that's the government's job, is to keep us all in check. But then we have to just assume that everybody there is doing a good job and they're completely infallible and also completely upstanding morally and ethically. But I think when the temptation arises, and I think there's been so much, I hate to say, corruption in government where, if somebody's taking something, well, I want my share. Well, hey, they're getting it. Why can't I get some? I hate to go down that road, but I think it's just been let go so long, especially when congressmen and, all our lawmakers and the people in politics seem to be able to do insider trading. They can make rules. They can, buy stocks right before their own committee gives a huge multi-million or multi-billion-dollar contract to a company. And they can front run the stocks and do things that, you and I can't do. I think people in other areas of the government say, well, wait, our elected officials are doing it. Why can't I do some of this? And so I think it just opens the door to a lot of mismanagement, maybe a lot of neglect, maybe turning the eye the other way. But to have it get so bad that there's that many millions of people getting Social Security checks we know are, not real, is no wonder the Social Security Trust Fund is going broke. Not just that. I think it's going broke because it's being mismanaged and being borrowed from and, not being treated like an investment account that should be there for the people that paid into it. I have one client or one listener that writes in and comments on Social Security, probably listening right now, but it's always social insecurity. Well, to many people, it really is social insecurity and it should be Social Security. But looking at the trust fund and how fast it's depleting and finding out all this waste that must just finally made public, bless his heart for doing it. It's about time that we have accountability and we find our taxpayers. I mean, the taxpayers' money, I paid, a lot of taxes.
Yeah.
And it really frustrates me. It makes me not want to even pay taxes. It makes me want to be a tax evader. I don't want to pay taxes knowing that it's just being thrown away or, their insiders are taking it. The people that work in the government that I'm paying, that I believe are getting a fair salary and a great retirement plan, good benefits, and all the things that, is why they got a government job in the first place. And now they want extra and taking my tax money and, giving it to their friends and cronies and even, redirecting it to their own interests. So it's frustrating, but it's really great to see the blanket being pulled off of the, what's hiding under it. And so the light can be shed on the whole deal. So, I'm really excited about the direction we're going from the standpoint of holding accountable those people that spend my tax dollars. And I hope we can get to the bottom of this U.S. aid, what a joke that is, and all the other things that they're finding. And I think it's funny that they're getting such a bad time to Elon Musk. And he's got all your information. He's coming into your house. Let's remember, Elon Musk started PayPal. He has your Social Security number. So it's like he doesn't have anything that he doesn't already have. And the other thing is, somebody mentioned that, Elon Musk builds rockets for NASA. He's got top security clearance already. Why not get somebody that's already been vetted in that position that doesn't need to steal your money because he's got billions to do the job. And he's already got the clearance. He already has the information. He's never been accused of or found to do anything wrong with it in the first place. I would love to have him in charge than somebody I've never heard of and has never been in a position where so much is at stake and where they have exposure to so much of the nation's finances. I'd rather somebody like him be in charge. I just think it's funny that they're making such a big deal about it. And I think the only reason they are is because they know that when the light gets shed on them, they're going to see that they're part of the problem, that they're part of the corruption. I don't think it extends just to the Democrats. I know they're the ones that are yelling the loudest, but a lot of the Republicans, I think, are getting ready to hide too, because I think their hands have been in it just as bad as the Democrats. So maybe not just as bad, but bottom line is it's not a party thing. I think it's just a government thing that's been the status quo for so long that corruption isn't seen as corruption anymore. It's seen as, well, your money's our money and we're the elite people and we should be able to manage it how we want to. You elected us, so just shut up and go do your job and, keep sending us money.
Well, Elon Musk again showed that there were 20 million Americans listed over the age of 100, according to that Social Security chart. I did look it up, Jeff. According to the Population Division of the United Nations in 2021, I realize that was 4 years ago, there were approximately 90,000 centurions 100 plus, or a prevalence of 0.03%. So there is a lot of waste going on here with Social Security, and I'm going to say fraud as well, too, because as you said, those Social Security checks are getting cashed, and I don't know how that's happening, but nevertheless, they are getting cashed. So anyway, I think we're on the right path there with Elon Musk looking into this. Let's talk a little bit about inflation. The report showed that overall prices have risen 3% since January of 2024. With that in mind, I know that the Fed is going to be having a meeting in March here. Does it look like that we're going to have another rate cut? We're going to stay the same, or is it even possible that we'll raise rates as a result of this inflation?
Well, I know if Trump has anything to do with it, he doesn't want rates to go up. He wants rates to go down. And I think the last few things that the Fed said, that Jerome Powell said, is that, well, hey, inflation, yeah, it's not the 2% like our mandate and like we promised to get it to. But, hey, the economy still seems to be doing good, even though we have inflation. And, oh, well, it's not really that bad. We don't really need rate cuts. I'm not in any hurry. Well, I don't think he should be in a hurry because, we had I think it was Volcker back in the bad inflation days. I was just a kid, but he allowed interest rates to get way high in order to get out of the inflation problem that, we'd happened through the Carter era. And, there was some really tough inflationary pressures that needed to be curbed. And, he had the guts to do it. It was not easy for most people to afford interest and, afford to buy houses and all those things, but it did get the inflation problem under control. And we got back on our feet and America became the greatest place to live and buy things. And the economy grew really well, but I think the present administrations are afraid of what it'll do to the stock market. They're afraid it'll do to their reputations. They won't get elected again, and nobody wants to do hard things. But we're in a place where we've got so many bubbles going on. They're going to pop eventually, and nobody wants to be the one that they point the finger at when it happens. So I think they're still trying to manipulate best they can. There's been a lot of money printed. There's still enough. Unfortunately, it's circulating within mostly the upper middle class to wealthy people that can still play in the market. And some people that probably shouldn't be that are still, dabbling in it, that are still buying up and overpricing the stock. So, when the stock market does as well as it's doing, everybody thinks the economy is good. But there's a handful of companies that are increasing earnings that are doing really well. And by and large, the economy isn't doing all that well. You're going to have a lot of layoffs. We're probably going to have some inflation if tariffs really get installed, at least at first. There's going to be some interesting times ahead. So, the market, is still going well. It appears the economy is doing well. They could actually raise rates, and I don't think it would slow a whole lot down. There's a lot of positive feelings and a good vibe now that Trump's in office and that he's talking a good game. They're finding the fraud and waste in government. They're doing a lot of things that are making people in general, Main Street people, happy and comfortable, or at least confident in the future. So I think it's going to probably increase inflationary pressures. And if they don't raise interest rates, I don't know how they're going to get it under control. Otherwise, we're going to have inflation again. So I definitely don't think they should lower rates anymore. I think we've got to wait for this thing to play out. I do think we need a market correction. It's something that looks like it has to happen. Bank of America just last week said, hey, we're on the verge of a big market correction. It doesn't look like there's any other way out than to have one. And, they're a pretty big market maker. And to say that when they've been divesting from the market for quite a while now, if you look at them and the other big banks. But the private household, what we call sometimes it's called dumb money, or the tourist investors, they don't really do anything by, fundamentals. They just do it by, oh, it sounds good. The news said we should buy this. Yeah, let's go. That's what's, driving the market. But those are the same people that are going to get hurt the worst, if we ever have this big correction. I think after a correction, I think interest rates go down just to give us a chance to kind of regroup and, start buying things and grow the economy again. But, the thing is over history, the economy, economics, basically there's economic cycles and they end up in bubbles and they pop. And that just is history. It's always happened. And we're at that point where we have those bubbles again. And we've been there for a couple of years now. Some people say, yeah, Jeff, you've been saying that for a long time. Well, we have been. Now, I don't know when they're going to pop. I don't know how much elasticity we have in the bubble, but there's obviously a little bit more. And I think there probably can be a little bit more air blown into the balloon before it pops. But, I don't want to be in it when it pops. The government is afraid that if they raise interest rates, it's going to pop the bubble. But honestly, the bubble's growing just fine without interest rate decreases. Inflation's coming back in real numbers. I mean, it's going up, not down. It's not even staying the same anymore. The last few inflation readings are not good. So,
No.
I don't know what choices they have other than to leave it the same or actually raise interest rates.
Well, if our listeners are worried about 3% inflation in this country, consider this. Argentina saw inflation ease in 2024. It's down to 193%. 193% inflation in Argentina. Why is it so high? Well, the government has consistently spent more than it earns, leading to borrowing and printing more money to cover its debts, which fuels inflation. Does that sound familiar? I don't think we're going to get to 193% inflation here in the United States, but certainly right now we are going in the wrong direction. You're listening to Premier Retirement with Jeff Ogan, founder and president of Premier Retirement Planning and Wealth Management, right here in Tucson. If you like what you have heard this morning, you want to sit down with Jeff and talk about how these current events will affect you and your journey towards a confident retirement. If you're not sure you're on the right path, maybe you have a plan from another advisor, you want a second look at that, we're welcoming you today to call this number, 520-780-9059, to get in touch with us here at Premier Retirement and request your Premier Retirement Roadmap. Just a casual conversation, no cost, no obligation for this. A chance for you to sit down with Jeff on a one-on-one basis and talk about your individual situation. As I said, it's not going to cost you a dime to do that. Once again, that telephone number, 520-780-9059. Now, you can call it this weekend if you want. It's going to take you about a minute to do that. Just leave your name and telephone number. Shelley will call you back during the week and set up a time for you to sit down and talk with Jeff. Going to be about a 30-minute conversation. It can be less if you want, or it can be a little bit more. But again, it's not going to cost you anything, and I want to underline this. There is absolutely no obligation. It's just a chance for you to see what Jeff thinks about what you've got and where you're going on your journey towards a confident retirement. Again, 520-780-9059. You can also find out more about us online at premret.com. It's premret.com. Jeff, let's get to our next topic here, and it's answers to some key questions about IRAs, 401ks, and annuities. Combining annuities with IRAs and 401ks really can be quite powerful because annuities offer principal protection and guaranteed lifetime income. But I think there is some misinformation out there and confusion about annuities within IRAs and 401ks. You actually can do that. You couldn't have always done that, but now you can do that. So why would you want to put an annuity within an IRA or a 401k?
Well, honestly, I haven't seen the 401k plans that offer the annuities, unless it's just a pretty simple fix for principal protection, like at Fidelity and some of those things. But as far as the annuity industry, the insurance industry has tried to step up and create situations where people can make their own retirement pensions. I mean, why not? It's a qualified plan. I mean, if you have a retirement pension at work, they're socking away money in something kind of like a benefit plan because they're defining how much money you're going to get at retirement rather than a contribution plan. Then there's defined contribution, meaning you can give up to X amount of dollars every year into, a plan, invest in the market, and see what happens. But when it comes time to retirement, if it's in the market, your income is going to be on the see what happens basis as well, unless you have what's that defined benefit plan. Many people like the defined benefit plan. They know I've got guaranteed income. I've got my Social Security, $3,000 a month. I've got my pension, $4,000 a month. There's $7,000. My spouse has got another $5,000. We're living on $120 a year, $10,000 a month. We should be able to be okay on that since we have no bills and we still got another $1 million in savings somewhere. So, great. Okay, that's good. Well, if you had $1 million in a 401k or IRA and it was all invested in the market, I can remind you about the story of Norm, which I tell probably once a month, maybe, well, a few times a year anyway.
Yeah.
And it's the opening story of my book of why the road to retirement is to prepare, but the road through retirement is a whole different story. And that is Norm had $1 million in assets during the late 90s, and he decided to retire at the ripe old age of 60 because he hit $1 million, which was his goal. Now that in today's dollars, probably $3.5–4 million would be the equivalent in order to create the same lifestyle. So he decided to live on, his $70,000 or $80,000 a year, which was about net of what he was making before at 120. And the market crashed and he burned through all his money so fast. 10 years later, he comes to me and says, Jeff, I've only got $250 left. You seem like a smart guy. Can you help me? No, you just spent your money when the market was down. If he could have gone back and taken that $1 million and put $700,000 or $800,000 in something that would give him $60,000 a year, put the rest in the market so where if it went down and lost 50% or more, his $200,000–$300,000 left would have lost 100 or 150, but he'd been able to wait on it because he had $60,000 a year in income coming in. And the rest would have been made up through maybe a little part-time work if he had to get a job, or the Social Security that was going to start as early as 62 if he wanted to. Or if the market didn't crash, then, he'd still been making money and he could have deferred some of that income, but he would have still been okay. Bottom line is, when he met me 10 years after the market crash in 2000, he was down to about $250,000 because he'd just gone through his second crash. And the whole time he had to work. He took Social Security early, and he was now pushing 70 years old and didn't know how he was going to make ends meet, that he only had about 3 or 4 years longevity based on his limited Social Security checks and the fact that he didn't want to work part-time at the golf course anymore. He was doing some maintenance and things like that so he could golf for free and didn't have to pay his membership dues and make an extra $20,000, $30,000 a year. He didn't want to do that forever, but he was stuck in that position because he didn't take the approach of saying, you know what, I should have just bought an annuity, or I should have just bought some fixed income or guaranteed income with some of that retirement money. And that's what people really should start doing in their 50s or in their early 60s, at least 5 years or so before retirement if they can, because those annuities give a guaranteed rate of return during the deferment period and a guaranteed income regardless of how the market performs. We don't know what's going to happen in the next 5 years. For the last couple of years, I've been thinking we're due for a good bubble pop. And so if you're in the market, great, you've made a lot of money. But if you're ready to retire or using that money for retirement, you probably better not be putting any of that money at risk. And I still believe that, even with Trump in office and the economy looking a little bit better, the market's been making new highs. Yeah, well, it has for a while, but it's also looking weak in a lot of sectors, and there's not a lot of consistency to the gains either. So there's still a lot to worry about. But if you look at just riding the market out for the next 2 or 3 decades, okay, so the market hasn't crashed in the last couple of years, but I guarantee there's going to be 2 or 3 of them in the next 3 or 4 decades. How are you going to withstand them when they do happen? Do you have that guaranteed income that's going to support you through retirement so you don't have to get that extra job, or you don't have to take Social Security earlier, you don't have to dip into your savings or ask your kids for a loan, heaven forbid, or take a reverse mortgage on your house because you have no other way to make ends meet from your bills compared to where the fact that you've used up all your money and the only money you have left is equity in your home. Hopefully you even have equity in your home. So there's a lot of things that you can do, but there's less things you can do when your back's up against the wall. And the best time to do the things that you ought to do to prepare for the future is in advance, so that you predict the future, you guarantee some income, and you avoid those costly mistakes. You have to make hard decisions when you're under stress, or when your money's getting beat up by the market and you don't know what to do and you're not thinking clearly, or when you've taken enough losses and you can't afford to be in the market anymore. I mean, some people really could have afforded to be in the market, because they let the last market correction lose too much money. They had to go to cash. They didn't set aside those assets that would help protect them for that future income until after they started losing money. So for that reason, we think annuities are awesome for IRAs. I mean, who cares about the required minimum distributions? If you have guaranteed income that you know what you're going to be taxed on, it's going to come out over time, then those required minimum distributions aren't going to haunt you in the future. And it's going to make life a lot more stable for you from an everyday standpoint. So we love annuities and IRAs.
Talking with Jeff Hogan here, Premier Retirement Planning, Wealth Management in Tucson and Mesa. And again, if you have questions about anything we talked about, or particularly annuities or basically anything, our phone number, 520-780-9059. You can make that call this weekend to set up your appointment. 520-780-9059. Leave your name, number. Shelley will call you back. Find a good time for you to sit down and have that one-on-one conversation with Jeff. Absolutely no cost and no obligation. We'll also give you a copy of Jeff's book, Retirement, The Road Ahead. We did talk about that. You talked about Norm in that book. And I want to point out that we do have hard copies of that book. But if you'd like to download it, you can simply go to premret.com, look under the Resources tab, and you can download that book. It's a very good one and well worth the read. Jeff, it's time for us to take a break here on Premier Retirement. When we come back, we're going to answer some listener questions and more when our show continues, right here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Thank you so much for making this part of your weekend. You're listening to Premier Retirement with Jeff Hogan every weekend here on 790 KNST. By the way, we're on the radio for you 4 times a week. We're on the air Saturdays at 7 a.m. Our show ends at 8 a.m. You just got to wait another hour till 9 a.m. to hear it again. And then also we're on at 1 p.m. on Saturdays. And if that's not convenient for you, we're also on Sundays at 11 a.m. And if those times are not convenient for you, we're also a podcast. You can go to wherever you get your podcast, search for Premier Retirement with Jeff Hogan. Also, you can go to our website, which is premret.com, premret.com. just click on the radio tab there. You'll find this show and many of our past shows so you can stay on top of your journey towards a confident retirement. Again, if you'd like to get in and talk to Jeff on a one-on-one basis, no cost, no obligation, our telephone number for that, 520-780-9059. Make that call this weekend if you want. Leave your name, telephone number while you're thinking about it. Shelley will call you back during the week and set up a time for that appointment. Again, there is absolutely no cost. There is no obligation. It's just a one-on-one casual conversation to get your questions answered with Jeff. And again, 520-780-9059. Okay, Jeff, time for listener questions. We'll kick it off this week with Russell listening to us in Tucson. Russell says, I've heard of trusts, but what is a family trust? How do I know if I need one? And if so, how is it set up?
Well, a family trust is really no different than typically, and it's typically referred to just as a family trust because it's you are putting all your assets in trust. You and your spouse, or probably if you have one, you're the trustee of the trust. You're the trust maker and the beneficiary. However, the heirs could all be the children. The successor trustees could be in your family as well. Keeping all your assets owned by a trust, which is, kind of family-owned trust. Now, you can expand that, and some higher net worth individuals have a family trust big enough to be considered a family bank, where, it's kind of operated as a business where there's different entities within the trust and you operate separately. That's probably more extensive than most people need, unless you have tens of millions of dollars in multiple entities, and maybe you're trying to hide assets and not hide, but protect assets through LLCs and some other means to diversify your holdings and so forth. But typically a family trust is just another name people give to a revocable living trust, a living trust that passes on to your family. It keeps your assets out of probate. It doesn't necessarily protect them from creditors and predators unless you use irrevocable provisions, which you can also do in a family trust. In fact, a family trust could have generation skipping provisions. It could have a charitable remainder provision for IRAs where you don't have to pay tax on them, but your kids can get distributions over more than the 10 years, which is normally required just in passing on an IRA, for example, nowadays. So people can use trust on a family trust to distribute assets to their family in multiple different ways and kind of beat the traditional rules of this way, that's the only way you can do it. But through a trust, there are some different methodologies you can use and different techniques you can use to not only hold assets, and sometimes in some cases hold them kind of more stealthily than, say, just the typical traditionally held accounts, as opposed to one in the trust. When you have your trust name on it, or a trust name that might not even be your name, some people might find it harder to find you or to find those assets if somehow you want some sort of a layer between you and the rest of the world. It can be, in some ways, a protective measure. But bottom line is, a trust is just an entity that you can keep your stuff in. You can manage that trust as long as you're alive. Other members of your family can manage it when you're not able to, or when you die, or when you're just disabled. And those people can continue to manage it for another generation. Typically, you can't go more than 2 generations deep on those type of trusts. You could even skip your kids if your kids are wealthy, and leave everything intact for grandchildren and so forth. So we've talked about trust before. There's a lot of different ways you can do it, but I think just the word family trust is probably too hard to answer. There's so many ways that family trust could go, but most people just call it a traditional trust, a family trust, if it has to do with protecting your family's assets.
Jeff, I've heard of people putting a house or a car in a trust. Why would someone want to do something like that?
Well, I don't think it's really a big deal to put a car in trust. But most people use a trust. For example, I'm a certified estate planner. We do a lot of trusts here. I don't write the trust. I use doc preparers and lawyers to do that because that's their job and they do a better job of it. And I'm not an attorney. I'd rather have an attorney actually draft documents. But as far as advising and setting up trusts and setting up accounts and financial plans based on trust is no big deal. If you put your house in a trust, it doesn't have to go through probate. The trust still owns it. So when you die, there's still an owner of the house. So there's no transfer of assets. It stays in the trust. Now, you could put your children, as if you have a spouse and you both die, you can put your children on as a successor trustees, and then they could either sell the house, rent it out, or pick somebody to live in it, or have one child inherit it and buy out the other one for the other half. They can make their own deals outside of court, outside of probate. It's just a simple way to do things. In Arizona and other states, about 8 or 10 other states that have what's called beneficiary deeds, where you don't need a trust necessarily to have your house avoid probate, but it can skip just by putting beneficiaries. Now, in that particular case, all beneficiaries listed on that deed would have to sign off. If there was a disagreement on the beneficiaries, one could kind of hold up a sale or make it difficult for the others to get what they want. But in a trust, you might have 3 children and maybe one of them super responsible, and that you can count on them to do what they would say. One maybe is a spendthrift and just is not good with money, and maybe the other one married somebody you don't like and are afraid that they're going to get their mitts into your stuff. So you want to leave your assets or that house or bank account or car or whatever it is in the trust so that you're responsible, or the one you trust the most. That's why they call it a trust. The successor trustee who you trust the most can handle those things according to your will, not your will as a document, but according to how you want it. The trust would spell out the distribution wishes that you would have, and then the trustee would be entrusted to do those things. When people have different levels of responsibility, different levels of accountability, different levels of competence and so forth, you might want to use a trust and just make sure that somebody's in charge of your stuff that you trust. Some people can use, if they don't have heirs or anybody they trust, can use a trust company or a firm. Frankly, I've never seen those outcomes. I know somebody listening that use them might not like me saying this, but they typically charge too much. They do very little work. They self-serve, they self-deal. And, honestly, a trust company acts like they own your money. And it's not really the money of the heirs anymore. I've got clients that have left their assets to their kids in trust, and their kids make a petition to get money for their needs, and the trust company gets to decide whether they need it or not, or whether they want to leave it under management and continue to collect fees. Oh, and by the way, they'll probably charge for every consultation you come in as well. So it's trust companies can be a money grab in many ways. Be careful about using those. It's really in a trust. My opinion, based on history, based on my clientele and 30 years plus in dealing with the type of normal people that I deal with, not, way out situations, but in general, the majority of the public can just find someone they trust, keep it out of probate, give them the instructions, and let that person use logic and common sense and follow the directions that you've given them to do your will, rather than leave it in the hands of somebody that doesn't really know you, doesn't care about you, and says they're a fiduciary, but might be acting in their own interest rather than what you expected to be done with your trust assets once you're gone.
Russell, thanks for that question, and thank you so much for listening to us in Tucson. We'll send you out Jeff's book, Retirement: The Road Ahead, or you can download it by going to premret.com. And again, if you've got questions, Russell, 520-780-9059. Come in and sit down with Jeff. He'd love to talk to you. Next question, Jeff, is Jim in Reedy Ranch. Jim writes, I'm 55 years old and planning on having the option to retire in 5 to 6 years. I understand the logic behind having a 2-year cash bucket going into retirement. However, I was wondering if you could share the pros and cons of building a bond ladder that matures in years 1 to 5 that would wholly provide a similar outcome versus having the 2 years in cash supplemented by the bond ladder. Are there options that I should consider?
I think there are options you should consider, and we talked about it earlier. Annuities, you can ladder annuities as well. I'm just set one up for an older gentleman that really, is getting tired of CDs. You can ladder CDs. What laddering means is just basically buy a series of similar assets, but have the maturity dates extend over a period of time. For example, you could ladder a CD ladder, buying a 1-year CD, a 2-year CD, 3-year CD, 4-year CD, and a 5-year CD. Maybe they all have different ranges of interest. Actually, the longer term CDs have lower returns than the earlier expiring terms. The interesting things is, we've had this yield curve inversion where short-term rates are higher than long-term rates. And the banks realize that long-term rates might start falling as well once we get inflation under control, if it in fact does. And if there's enough pressure on the Fed to start lowering interest rates, and it actually, or if there's a market correction, which we probably should have, I think that'll be a great time to reset and kind of get some more reasonable interest rates available. So, you might be well off locking in some good rates now for 5 years because you're scared that it's going to drop, but you're not going to get top rates on a CD. You might want to go bonds. The bond ladders, here's the thing with CDs and bonds though, is as you earn interest, every year you're going to get a 1099 on that interest, whether you're using it or not. So if you're just saving it for 2 to 5 years because you want to have money in 5 years when you retire, you might even want to do a bond ladder where, there's a couple of different ways I can go with this, but where you have actually fixed annuities. Insurance companies, based on the way they invest and based on the way that they can buy bonds at a discount where you and I can't, they're offering from 4 to 6% on fixed annuities that are guaranteed to pay you that interest rate for anywhere from, generally speaking, not 1 year, but usually 2, 3, 4, 5, 6, 7, and 10 years terms are very common. You could ladder annuities. And the cool thing about that is they mature just like a bond does. They're secured by bonds. The insurance company actually insures them and makes them more secure than just the full faith of the bond writer. And you have a couple extra layers of protection when you do an annuity. These are just fixed annuities, just like a bond account, and they'll guarantee you a start to finish rate. The cool thing about annuities is they are tax deferred until you pull that money out. So if you're in your 50s, don't plan to use the money until you're in your 60s, or at least past age 59 and a half, because deferred interest is penalized if you take it out early before 59 and a half, kind of like an IRA, by the way. Some people don't know that. So be careful if you do buy annuities, make sure that you're not going to be pulling out that interest before age 59 and a half. But if you're going to ladder them, or you could ladder them and just keep rolling the 1 year over, rolling the 2 year over, and so forth. I would get higher interest and lock it in that way. It's still secured by bonds, plus secured by insurance company surpluses and reserves and things like that, plus a guarantee fund that each state has. So there's certain things that might make the annuity a little bit more attractive, especially the tax break. Since you're earning money right now, you probably want to defer those taxes if you're just going to accumulate and compound that interest anyway. Now, there's another technique that has been included now in indexed annuities where you also have indexed ladders, where you have a variety of indexes built up of indexes, where you have principal protection, where you can't lose. But if history repeats over the next 5 years, you might have 1 or 2 bad years, but over 5 years, you're not going to have all 5 bad years. There's never been a time that I know in history where you've had 5 bad market years in a row, maybe 2, 2.5 max, maybe 1 really bad one, and then things kind of get choppy and then they come up. You can have a laddered indexed annuity strategy now where you have a 1, a 2, a 3, and a 4, and a 5-year index. The longer you hold that index, the more money you make. But you have a 1 year that renews every year and relocks in the rate, a 2 year that locks in every 2 years, and so forth. That might be something you want to start now and take into retirement. Because if you look at the back testing of those indexes, they beat CDs and bonds by a large, large margin. And if you're only locking in a 3 or 4% rate anyway, and you can't lose money because you're getting ready for retirement, this might be an option that you want to look at. We've been doing a lot of business in these lately, and they're kind of new product. It's kind of a new twist on indexed annuities, indexing, where you can actually ladder indexes. And the back testing are huge. I mean, again, back testing, history does not prove future, but, there's a lot of things, cycles and stuff that continue to repeat. Bottom line is you'll probably get some of that back testing to come true, and some of it might be better, some of it might be worse. But these are approaching double-digit or better returns. So you might want to consider maybe a couple of different ladders. The nice part is they are tax-deferred, they are principal guaranteed, and you might get a little bit more bang for your buck if you explored outside of the bond and CD world, which the banks and the brokers are the same, by the way. Bank of America, Merrill Lynch, Citibank, you got JP Morgan, Chase Bank. They're all one and the same. So they only want you to know about CDs and bonds because that's how they make their money. I mean, insurance companies are an entity or an institution that offers an asset class that the banks and brokerage firms don't offer. In fact, they try to down talk them. But guess what? It's a tool you ought to have in your bag. They have a lot more, in my opinion, more security, better interest returns, better protection, and tax deferral. I think those are all benefits that may make you want to expand your horizons a little bit and step out of just the bank brokerage world into a world where you make a little bit more, have a little more security, and build on products that were actually built for retirement.
Jim, thanks for listening to us in Rita Ranch. Again, we'll send you out Jeff's book, Retirement, The Road Ahead. If you'd like to come in and sit down with Jeff, 520-780-9059 is our telephone number. Jeff, next question is Patrick listening to us in Oro Valley, and Patrick says, I've just retired last year, and I'm creating my retirement paycheck. I have after-tax funds, before-tax funds, IRA and 401k, and Roth accounts. What are your thoughts on proportionally withdrawing from all each year versus the traditional order of taxable, pre-tax, and then Roth?
Well, as usual, I'm going to say the basic answer on this because I have very little information to go on. And that is just, hey, what should I do? Well, I don't know your situation. I don't know what tax bracket you're in. I would say, generally speaking, the rule of thumb is spend your taxable now because it causes you less problems later, or convert your taxable into non-taxable later. I love to convert. Let's just say you have $500,000 in each of the 3 types of assets. I'm just going to use those numbers. $500,000 in mutual funds and different things, CDs and whatnot, that gives you a tax bill every year. And, let's say it's $25,000 on average, but some years it's zero or a loss. And some years it could be $50,000. So you really don't know what tax bracket you're going to be on those dollars. So sometimes that's why people say, hey, spend those first because, that's your, I don't know, money. And then you have, let's say you have $500,000 in a regular traditional 401k or IRA, and that's going to be taxed as you pull it out. Well, then somebody said, well, pull that out because you could pay taxes now and not have to pay taxes later. Okay, that's fine. If they're all invested similarly, then you've got the Roth that will continue to grow tax-free. Why would you want to spend your tax-free money that could continue to grow until last? Now, the only reason I would spend it is if the first 2 buckets are causing you to go into a new tax bracket. Let's say you're maxing out your income at $120,000 after write-offs and everything, you're in the 12% tax bracket. But if you took another $20,000 out of your regular IRA, you would have to pay tax at 22% instead of 12. You're like, man, that's a big hit. Well, in that case, it might be smart for you to take some out of the Roth as well. In fact, sometimes you don't even know how much you take out of the Roth because you have no idea what you're going to make on that taxable account. What I like to do is use a lot of that taxable tax now income and move it as quickly as we can, maybe over 3 to 5 years or 4 to 5 years, into a LIRP, life insurance retirement plan. Now, why would I use life insurance? You're thinking I'm crazy. Well, it's never taxed. You leave the money in there. You borrow against its growth. It's principal protected. It grows like an indexed annuity. Average rates of return are in the 6 range. You have to pay for the cost of insurance, which over the course of your lifetime will average about the same cost of what you'd pay it for a mutual fund or pay me as a fee to be an advisor, if you look at the actual costs involved. And then you don't actually take the money out like you do a Roth. You don't take the money out. You just borrow against it. And the even more cool thing about that is it never triggers a tax event. It never triggers a 1099. It's never used as provisional income to decide how much more you have to pay for your Medicare or how much more in taxes more of your Social Security is going to get taxed, because it's not considered provisional income. Provisional income is only be considered from the earnings that you make on your taxable investments, the surprise tax money, or the IRA money you're pulling it out. And even the Roth money gets reported to the IRS, even though it says not taxable, it's still income to you. It's just tax-free. So wouldn't it be nice to have something that you can control the income, not pay a tax on the growth, continue to let it compound, and use it as a kind of an extra Roth? It's like a Roth on steroids, but for your after-tax money. I've already paid taxes on it. Why do we want to pay tax again or continue to pay tax over and over again if you're just going to use a portion of that interest? So, my opinion is build the whole plan out, see what it makes sense, and do it that way. Don't just say, I want to do it equally, or I want to do it all from one or none from one. I think there's probably a balance of some from each one that you might want to use. Or if you're not using a certain amount of assets, but you're still underneath the tax bracket, cutoff line, then you either do a Roth conversion with your IRA money and spend the taxable money, or spend some savings from the bank, or you continue to put that bank and savings and after-tax money into a LIRP and shelter it that way. So my opinion is get everything in a place where you can predict your tax bracket in the future. And you really can't with some assets. And that's the unfortunate part, where some people have said, well, I already maxed out my 401k and I've got all these other investments, and boy, I'm making a lot of money. I'll never be in a lower tax bracket. Well, why not? Well, move it out of the tax bracket. Move it into something that isn't taxed. The money you save in taxes might be pretty significant, might be more significant than the gains you think you can make by managing it in the market or doing some other things in a risky roller coaster ride account, or by paying fees to institutions for mutual fund management, or to advisors for advising you and charging a fee for it. So again, look at all the options, consider other asset classes, and we have to know what tax bracket you're in, what your income is going to be. And really the unknown is that taxable account, the tax now account, because you just never know what tax bracket you're going to get until usually after the end of the year.
Patrick, thanks for listening to us here in Oro Valley, and we appreciate that question. And again, if you have a question you'd like us to answer on the air, you can get it to us 2 ways. One, you can call it in Shelley. She'll be happy to take that down for you. Or you can go to our website, which is premret.com, put it in the contact page there, and if we use it on the air, you'll get Jeff's book, Retirement, The Road Ahead. Listening to Premier Retirement with Jeff Ogan, founder and president of Premier Retirement Planning and Wealth Management, right here in Tucson, also with an office up in Mesa. If you have missed any part of the program today, you want to hear it again, go to our podcast. You can find that online at premret.com, premret.com. We've got the show for you right there, or go to wherever you get your podcast, search for Premier Retirement. We got this show and all of our past shows, so you can stay on top of your journey towards a confident retirement. Jeff, let's talk about a question that we get regularly here at Premier Retirement, and that's someone who comes in and says, Jeff, I am just sick and tired of working. I don't know if I can retire. If someone says that to you, Jeff, what should they really be looking at to decide whether or not they can retire or not?
Well, I think first of all, you have to know about what you like to spend, or better yet, find out how much you are spending. Go back to your bank accounts and credit card statements. Find out what you're spending your money on. If you want to keep that same lifestyle, then that's the number you need to hit. Then you come in here and we go through a plan and we say, okay, how much of the savings that you have can generate, you can't really base it on 5% CDs because we don't know if we're going to have those forever. You can't base it on an average rate of return of 10% in the stock market because we don't know if the market's going to actually average that over the next 10 or 20 years. In fact, it's averaged so much more than that over the last 10 that chances are it's going to average less than that over the next 10 if we look at history. So how do we get to a point where we know if you can retire? Well, what's your Social Security going to be? What savings do you have to live on while you wait till an annuity matures or till you're old enough to get your full pension? Or do you want to wait on Social Security so you can get a bigger paycheck down the road because you want to spend some spend down some of your after-tax assets, or just spend some money that you have in the bank because it's not making much interest and you don't really want to tie it up in a CD. I mean, whatever your goals are, wherever your money is, you need to say, okay, what's the best use, highest and best use for that money? Let's say you have a nice IRA or a 401k that has a certain amount of money in it. Let's just round it off to $1 million. That's a good number for a plan. Let's say, okay, of that, if I need to make $60,000 from the rest of my money over and above Social Security, is it realistic to get that out of $1 million? Well, if you use the 4% rule, which has been touted as the safe withdrawal rate from a stock market-based account, basically stocks and bonds. Interestingly, stocks average 10% over the long haul, and bonds average at 4 or 5 or 6 over the long haul. Yet you can only take 4% out because we have to factor in volatility. Well, that right there tells you the stock market probably isn't the best place for retirement income. Now, on the flip side, if you retire in 2009 when the market's bottomed out, or even at the bottom of 2022 when the market, at the end of 2022 when the market had a nice 25% correction down and then is roaring back, you might be well off if you get lucky enough and the market sustains that and actually makes you money while you're pulling money out. However, what if you could pull, depending on your age, what if you could pull $600,000 out of that annuity and give yourself $50,000 income guaranteed for life in a year, and you could live on savings for this first year? Then next year you have $400,000, but you only need $10,000 extra. Well, what's 4% of $400,000? Well, that'd be $16,000. Okay, so that's probably a safe rate of return. And now you've actually gone from 60 to 50,000, which is absolutely guaranteed, even if the market doesn't perform. And then you still have access to play the market and to get the upside that's there if you want to. Or what you could do is ladder annuities, where you might have, half of it is money that I'm going to spend on a fixed guaranteed rate of return for the next couple of years. The other I'm going to let grow to be a guaranteed growth rate so that, at the end of the 3 or 4 years that I spend this money, it's likely to be worth X, and then I can increase my payments. I mean, you can play around with that other $400,000. The fact is you don't have to really hit it hard in order to make your goals. On the flip side, on the million in the market, even though markets average more, taking 6 out could really come back to haunt you, just like it did Norm. I told that story earlier in the show. $1 million, and because the market was crashing while he was only using about $50,000 a year, by the way. It's about a 5% withdrawal rate. And the market tanked, and he wiped out a lot of that capital that would have recovered had he had 10 years to wait it out and to let the market ride back to where it was. But he didn't, because he retired and because he needed that money to live on. So, you want to make sure that you reorganize your assets into categories where they produce income, have principal guarantees, and can support the income that you desire. And if we can get to those numbers and you feel comfortable with it, then the answer is, well, you can retire. Now you're working because you want to if you keep working, not because you have to. Now, if that number comes up short, you say, man, I better put another $30,000 away into my 401k for another 3 years so I can make sure that I have enough buffer. Well, then that's what you do. But at least you start with a plan. You find out where you are, find out where you want to be, find out what the gap is and how much you have to fill. And if there is a gap, maybe you need to keep working, or maybe you need to take some equity out of your house and downsize, or maybe you need to learn to live on less, or whatever. You can make those adjustments, but at least the options are there for you to see in full color, rather than, gee, I don't know if I can. Let's just give it a whirl and see.
Jeff, unfortunately, we're out of time for this week. Want to thank you for your time, but most importantly, want to thank our fine listeners for joining us here on 790 KNST. So for Jeff Bogan, I'm Jeff Shade. Have yourself a great weekend. Thanks for listening. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. This show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.